Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we've got
That's okay.
Copulsky with us, and Phil comes from New York City, from Manhattan, kind of via Utah and Seattle and into Texas and commercial real estate. So Phil, it's great to have you on. Just love to hear kind of how you got through that whole transition and into commercial real estate.
Thanks for having me on, Bruce. Grew up in Manhattan, same apartment for my entire life, went to school in upstate New York, graduated a couple of years after the GFC. I always intended to work in New York or somewhere in the Northeast. Wound up my first job out of undergrad at Goldman Sachs in Salt Lake City. Spent the first 2.5 years there. Transitioned to New York, worked for Goldman for another 1.5 years, and then did a short stint in Seattle with Russell Investments. Realized that I wanted to move more into tangible asset classes such as energy, infrastructure, real estate. Wasn't exactly sure what I wanted to hone in at the time. Decided at that point in my career it made sense to pivot and go back for an MBA full time. And so I did that in Austin for a few years, decided to narrow my focus on real estate, spent some time interning with both Invesco Real Estate in Dallas and Pennybacker Capital in Austin, and then landed with Westmount Realty Capital in Dallas and have been there ever since.
And tell us a little bit about Westmont and what you're up to with that particular group.
Sure. So Westmount's a privately held operator of mostly business for 40 years. Our founder, Cliff Booth, has invested in all types of property segments throughout his career. We've been invested in industrial that entire time. We have integrated capabilities from acquisitions to asset management, property management, in-house legal due diligence, no fund, no closed-end funds, open-end funds, nothing of that nature. All discretion is with our investors. We raise from 2 buckets of capital. One are for our smaller raises from syndicated passive investors, which include high net worth individuals, registered investment advisors, and family offices. And then for some of our larger transactions where we're taking down more equity, we partner with a large institution that will take anywhere from, call it 80 to 95% of the equity. We've partnered with big groups such as Ares, recognizable names in the industry. My focus is solely on raising family offices. I work on individual raises, so I'm very close to the real estate, discussing investment opportunities with investors. But I'm also focused on broadening the investor base. And so we have about 2,000 investors, many who've invested with us over those 40 years, but we're also out in the market canvassing new potential investors.
So I'm a little curious, how are you out marketing? Social media, direct contact? I'm curious a little bit about how that's working.
So I think we're a little bit different than a lot of syndicators. We operate under an SEC exemption called a 506B, which means we can't go through general solicitation. We have to have pretty buttoned up relationship with all of our investor ties deals. We don't advertise our platform from an investor standpoint. We do have marketing where we talk about our portfolio, but all in compliance with SEC regulations. I spend a lot of my time on my existing networks. Referrals are a big source of leads. We attend industry conferences where we're meeting with potential investors. We're speaking on panels, or we're sponsoring events where we are the featured speaker. And generally speaking, if you're performing well, then a lot of the marketing takes care of itself because you'll get a lot of warm introductions to new potential investors.
So it sounds like you haven't decided or wanted to jump to an actual REIT.
No, our investors have gotten very used to being able to customize their exposure and pick their deals. With a REIT, our investors typically lose that discretion, and it kind of deviates from what our investor base wants. If investors want exposures to REITs, they have avenues to get that exposure. But with us, they're looking to be able to pick and size their deals accordingly based on preferences for risk profiles, geographies, business plans specifically. And so if we transition to a fund or a REIT structure, we're starting to compete in a different universe.
So it sounds like your investors are very specific. They get into a specific deal, they stay with that deal, and then potentially roll it over if they want to go to the next uh, purchase that you might make. Oh, you froze up on me. Are you there?
Can you hear
Oh,
me?
there you go. Okay. Nope. Oh, there
What
you.
happens with fund vehicles is sometimes investor can
Yeah, go ahead. I think maybe you're slightly closer to your mic.
you hear me?
There you go. Okay.
So our clients, what the feedback we receive from our investors is that when they invest in fund vehicles, they don't ultimately know what their exposure is going to be. And what happens is then all the collateral in a fund vehicle is cross collateralized versus our deals where we're creating special purpose entities that contains exposure for our investors into one deal, and there's no cross collateralization of the assets or the promote to the sponsor based on performance, and that's what our clients typically prefer. The other thing that's important in our deals is we typically have more flexibility on our hold period. We usually underwrite a 4 to 5 year hold, but we're not forced to sell at an inopportune times if we don't want to. With a lot of the way the fund vehicles are structured, you have to deploy the capital within a certain period of time, called 2 to 3 years, and you have to exit within 7 to 10 years, irrespective of market conditions. And so if you were at the end of your fund life a couple of years ago when rates rose against you, you're probably not in a position where you want to be selling a lot of assets. But if you're at the end of your fund life, you really don't have much of a choice. With our structure, we can keep our partnerships open as long as we want. We're certainly dealing with issues, and you press up against loan maturities, and you have to be operating the assets well to be in a position to refi those deals. But you don't have the inherent pressure to sell just because you're at the end of your fund life. And our investors typically like that optionality.
So if somebody wants to bail out early, is there an option for that possibility?
We typically don't accommodate that. We have secondary funds that come to us looking to provide that option to our investors. We want more patient capital. We don't want transient investors who come into a deal and then the first sign of trouble 6 months in, they want out. We want investors who understand that there are bumps along the way in real estate. We have underwritten projections, but they're almost never right for us or any other sponsor. And so we've disclosed that pretty clearly in the operating agreement that there is no liquidity mechanism and not to expect one. And even though we underwrite a 5 year hold, it could be much shorter than that. We've held deals for under 2 years, depending on market conditions and how we executed a business plan. Sometimes it's a little bit longer. We're at the point of the cycle where we've held deals a little bit longer than we anticipated, because if we had sold in 22 or 23 when interest rates were at their peak, then we probably would have left some value on the table. And since then, rates have come in a little bit, and there's anticipation that rates might come in a little bit more going forward. And so you don't want to be in a position where you're a highly motivated seller. And that kind of goes back to the point I made about having SPs versus fund vehicles.
So you've kind of described the current and future market a little bit. Can you tell us a little bit of the geography of where you think maybe the market's going, where you think investments are good for your particular sponsors and fund groups?
Sure. We like markets, high growth Sunbelt markets, like a lot of groups in places like Phoenix and Dallas Fort Worth, where we're headquartered. And in the Southeast, we have a big presence in Atlanta, for example. We have a property management and asset management office there. The problem with those markets is now they've caught on with institutional groups, which means pricing starts to move away from you. And a lot of those institutions that have fund vehicles have a cheaper cost of capital than we do, which means that they can stretch on pricing in a way we're not comfortable doing so. And so we've been active in the Southeast. We have a very good presence there. We've looked at a lot of deals in Dallas and Houston, but those are priced very competitively, which pushes down projected returns, makes it harder to raise capital on those deals. We have a very sizable presence in Chicago with not just assets there, 4 million feet, but throughout the Midwest, Minneapolis, Milwaukee, Cincinnati, Columbus. And we feel like that's a market where you're not going to get as much growth as you might get in a market like Atlanta or Dallas, but you're also going to be able to buy at a better basis, maybe a better cap rate. And you don't have to be as aggressive with your underwriting assumptions to get a good risk adjusted return. And so we're turning a lot of stones in that market. I think some of those markets with investors are a little bit of an unknown, but they all have a pretty good story and the fundamentals, the operating fundamentals are pretty good. The other thing about some of those high growth markets is there's a lot of new supply in those markets, which have compressed rents and pushed up vacancy, especially in the logistics assets. I mentioned we don't do those, but there's a lot of vacancy in DFW, for example, and just single tenant assets in general. And so we feel pretty good about the demand drivers in the Midwest and the fact that even when rates were much lower, there wasn't a huge supply pipeline of new product coming in that would compete with existing product. And so it's kind of like when you think about the coastal markets where, in San Francisco or New York, it's very difficult to build. But if you're an existing owner in those markets, then that's naturally going to put a floor on rent growth, and you're generally going to be able to keep up with expense growth because you're going to get that inherent rent growth because you're not going to have to offer concessions as a landlord, or you're less likely to have to offer those concessions.
So what's your ideal purchase? It sounds like it's a multi-tenant building. What's the average size of your tenant?
Sure. So I think our sweet spot is an asset or a portfolio of assets spanning from 100 to 300,000 feet. And those tenant sizes can range from as small as 2,000 to 10,000 feet. Sometimes we'll buy deals with smaller suite sizes and larger suite sizes, but a lot of our portfolio consists of tenants that are occupying 2 to 10,000 feet, and we found that those are tenants that it might be their only location. It's a family-owned business. Tenants that are very defensive in nature. They're not as prone. Their businesses aren't fundamentally as prone to movements in the business cycle. And surely you're not dealing with investment grade tenants in a lot of cases. And given the just general market environment, we're working through some non-paying tenants, some tenants in bankruptcy. I think that's just a general characteristic of this type of tenant profile. But by and large, what happens is you have tenants that have been in spaces for a long time. A lot of these assets were mom and pop owned for a long time, not professionally managed. Rent growth far exceeded what the renewal rates were for a lot of these tenants. And so there's a big gap between market rents and in-place rents. And so you have a reasonable expectation that you can mark the rents to market. And the tenants, because there's not a lot of new supply of Class B industrial at that tenant size, then there's no real sorry. there's nowhere else for them to really go. And so most of them, and the build out is very specific to those tenants as well in a lot of cases. And it's very disruptive for those businesses to have to move.
Well, and
So
it
they
sounds
wind up
yeah, and it sounds like you're kind of avoiding the whole logistics and the potential or the whole tariff situation. Has that affected you at all at this point?
I would say prospective tenants are taking a little bit longer than they might have to make leasing decisions. Some existing tenants are deciding to renew for a year or two instead of what might typically be 5 years. They're not asking or requiring higher TI packages just because they don't think they're going to be in the space for as long, or they just want to have more optionality to let the market environment play out. That's what we're seeing on the ground, but the operating fundamentals for that segment of industrial still remain strong.
Yeah. So you're hopefully avoiding all the uncertainty that tariffs are bringing to the marketplace, particularly in the coastal port cities and so forth.
Yeah, our tenants are, I mean, some of our tenants will, it's a wide range of uses for these types of assets. So some will have dock doors, tenants will need a distribution capability, but most of our tenants are not looking for volume in terms of how they distribute product. So just as an example, some tenants might use a suite for light assembly, but then they'll have a dock door because they need to distribute product, call it once a week, or it's used as showroom space, or a portion of it will be office. It's not pure logistics.
Yeah. So are you in some respects kind of in a pause mode at this point? Are you in a wait and see mode a little bit? Or are you still pretty bullish on the market and looking to buy real estate particularly in the Midwest?
We're bullish on the market, but we're also very careful. It's been tough to make sense of a lot of deals. The way the deals have priced, um, just based on competition. I mean, there a lot is made about the bid-ask spread between buyers and sellers, and there's some element to it, but the deals that most investors want to be in get very aggressive from a pricing standpoint. And so we're actively underwriting and bidding on deals in the markets that we target. The problem is that the deals we like, other groups like as well. And so we start bidding on deals and we feel like we're underwriting conservatively, but then we'll compete with other groups who might be underwriting a little more aggressively than we are, which means they can offer more on assets. And so we typically acquire 4 to 6 deals per year. It's the past couple of years has been much slower.
Yeah.
And we're okay with that because at the end of the day, the more important thing is we feel good about what we're buying and we feel good about our ability to execute on a business plan. And we don't want to be in a position where we're stretching and then we have to, we suffer on the back end because we overpaid for a deal.
Well, are you saying that pricing is coming down right now? What's happening in the marketplace for the assets you're looking for?
I think pricing adjusted, but I think pricing is starting to stabilize. There are a lot of funds that have raised a considerable amount of capital for for similar type strategies, and many of them are reaching the end of their deployment windows. So I think partially what's happening is you still have a case where there's a lot of capital chasing probably too few deals in the market, which naturally pushes up pricing and gets us to a point where we're not comfortable. A lot of the deals on the industrial side still have level of positive leverage and make a little bit more sense based on what we're seeing, what we're underwriting. A lot of the multifamily deals we're seeing really just don't make sense. We haven't bought a multi deal in 3 years. And I think a lot of that is because you have a lot of aggressive syndicators who are still raising capital, even though they have deals that are struggling, and they haven't had to realize those losses yet. But I mean, a lot of these deals, I mean, they're trading at crazy cap rates. And if you're buying at a 4.5, 5 cap and you're financing at a 6 without having 5 to 10% rent growth as a tailwind, which you did have leading up to the rise in interest rates in 22, it's going to be tough to make sense of the deal. Not to mention the fact that on the multi side, you've had considerable expense growth, both for property taxes and insurance. And unlike industrial, you can't contractually pass those increases off to your residents like you can for a lot of industrial assets.
Wow. Okay. Well, we have covered a lot of territory here. I think we could probably talk for another couple days, but just for fun, let's end with what kind of food do you prefer to eat?
I like a lot of foods, but I would say as a native New Yorker, Italian is my favorite.
That's good.
I live in Texas now, and so I definitely like barbecue and Tex-Mex. But I think close to my heart is Italian food for sure.
And who in the world, alive or maybe not so alive, would you love to sit with some Italian food?
Probably Winston Churchill, but I'd have to be careful about that since Mussolini was his enemy during the war.
So that would be an interesting question, whether Winston liked Italian food. We may have to go back and research that. Well, this has been great fun, very informative, and I look forward to talking to you again maybe in 6 months and seeing where the market has transitioned to at that point. But let's keep in touch. I think you have fantastic information. So, at any rate, where can people get a hold of you, Phil?
I could be reached on LinkedIn. I don't have a common last name, so if you search me, I'll be the only Phil Copulsky on LinkedIn. You can also reach me through my Westmount email, pcopulsky@westmountrc.com. But LinkedIn is perfectly fine if you want to use that method. And I think if we talk in 6 months, we'll be in a drastically different market environment.
Wow. Let's do that then. I could be because that would be a very interesting conversation to see how the market has changed in the last 6 months.
Yeah, I mean, just as one example, I think multifamily overall is still strong and has good operating fundamentals. We're working through a lot of oversupply in the markets that we operate and own in. But I think a lot of that's going to taper going into 26. And I think a lot of institutions still like multifamily. But I think in terms of Class B, Class C, multi in the Sun Belt, I think we're still in the early innings of distress, and there's going to be a lot that needs to be worked out on that within that segment of multifamily.
So are you thinking, just out of curiosity, are you thinking you might pick up some assets, some distressed assets down the road here?
I mean, we're going to look at those opportunities. The thing about those deals that are distressed is you're going to have to be very, very careful from a diligence standpoint. And what I think is going to happen is you're going to look at a marketed cap rate, maybe 6, 7, which is much higher than what you would see on a Class A deal, but you're going to see potentially a lot of deferred maintenance. You're going to see a lot of bad debt on the rent roll. And so it's almost going to look like an office deal where you're going to have to look at everything below the line to really analyze what you're going to have to put into the asset to make it work.
Wow. Well, a lot of those high interest loans are coming due, and some of them may roll back to the bank, or the banks don't want them. So it's going to be interesting to see what happens over the next 6 months or so.
Yeah, and you're starting to see stories about that happening. And I think you'll see some more of that. So if we're talking in 6 months, I think you'll see quite a bit of that unfold by the end of the year.
All right. Well, let's put that on the docket where we'll start to talk maybe in January, February, and see what the new year brings.
Thanks so much. I appreciate the invite.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.